the Fed keeps raising interest rates. They might be done. I think they maybe have one left, but they're probably done. But we're at 5.25% on the Fed funds rate. But that's short term. The longer end of the curve is coming up, right? So rates are rising rapidly, even out on long duration. So we have dysfunctional markets because they're all artificial. How does that change? You have to let the market function properly. In other words, you have to let asset prices fall, and that's gonna entail a recession or a depression. And then the Fed will cut rates, and then the banks will heal. But you're gonna have to have this cathartic cleansing, purging of asset prices.
U.S. stocks are at their most expensive levels in over 2 decades, mirroring the dot-com boom followed by a 50% S&P 500 crash. The Federal Reserve's firm stance on higher interest rates and bond market turbulence has made the equities market cautious, leading to a dip in the S&P 500's year-to-date gains. Michael Pento, president of Pento Portfolio Strategies, warns that the stock market is significantly overpriced, citing high price-to-sales and total market capitalization to GDP ratios. One of the critical issues he highlights is the overly optimistic earnings projection for 2024, which anticipates a 12% growth in earnings. Even if inflation remains at low single digits, achieving a 12% earnings growth appears increasingly unrealistic. Adding to the concerns, Michael highlights issues related to the reverse repo facility and the presence of stressed bank assets. There are over $100 billion in stressed bank assets, which he describes as festering. These assets were provided to banks at par value despite trading at a fraction of their actual worth. The Federal Reserve's plan to return these assets to the banks is anticipated to bring significant financial stress to the banking sector. In just a year and a half, the Federal Open Market Committee, FOMC, has raised interest rates 11 times, pushing the key federal funds rate into a target range of 5.25 to 5.5%. This rate level has yet to be seen since early 2001, according to Bankrate's analysis of the Fed's historical actions. The Fed's rate hikes, especially on the short end of the yield curve, are complemented by a rapid rise in longer-term interest rates. This presents challenges for assets held at the Federal Reserve, as they are now even further underwater than before. Michael suggests that the Federal Reserve might need to consider rolling over these assets, which has inflationary implications and effectively translates to monetizing debt. Stay tuned for clips from Michael Pento's interview with Liberty and Finance. For more content like this, subscribe and hit the notification bell. Thanks and enjoy the video.
I do, because the stock market is extremely expensive by any metric: price to sales, total market cap to GDP, Shiller Cape ratio. So by any measure, the stock market is way overvalued. And the earnings projection for the growth in 2024 is 12%. 12% earnings growth, Elijah, in an economy that's going to be decelerating rapidly towards recession. And with inflation, you could get there just in nominal terms if inflation was 20%, but inflation is probably going to hover around these low single digits. So there's no way you're going to get 12% earnings growth. It's going to be closer to zero. And the market's priced for the soft landing or no landing, which is it just can't happen. I'll tell you, in the same month that the reverse repo facility runs dry, there's currently $100 billion, over $100 billion in distressed bank assets currently festering. I call it festering with the bank term funding program. And what happened was the banks were bankrupt back in March, right? And the reason why they were bankrupt is because deposits were fleeing the system, because banks couldn't raise their deposit rate to match anything close to what the Treasury was paying them. Well, that's gotten worse. That condition has gotten even worse. And those assets that are at the bank term funding program, banks were given par value when these assets were trading at cents on the dollar, pennies on the dollar. Now the Fed is supposedly in March giving these assets back to the banks, and the banks have to return 100 cents on the dollar to the Fed when these assets are worth even less when they were bankrupting the entire regional banking system. The Fed keeps raising interest rates. They might be done. I think they maybe have one left, but they're probably done. But we're at 5.25% on the Fed funds rate, 5.3 effectively on the effective Fed funds rate. But that's short term. The longer end of the curve is coming up. right? So rates are rising rapidly, even out on long duration. So these assets that were parked at the Fed are further underwater than they were when they first went there. So if Powell gives them back to the banks, these banks are going to be going bankrupt one after the other. So he can't do that. So what he's probably going to end up doing is rolling over these assets, which has inflationary implications. Because in effect, then isn't he then monetizing this debt again? So you either have you're either going to have a recession, depression, and rapid deflation, or you're going to have runaway stagflation like we've never seen before. That's where we're headed. Either one, it's binary because you can't have it both ways. The economy can't exist when real interest rates are positive. There's just too much debt outstanding. Government can't fund itself. Corporations can't survive. The real estate market can't withstand where, the real estate market is higher today than in 2006, the prior apex. And I don't mean just nominal prices. Of course, that's true. But as a percentage of income, the real estate market is out of reach. The real estate market is frozen.
The recent turbulence in U.S. Treasuries goes beyond short-term economic indicators and the Federal Reserve's interest rate intentions. It signifies a fundamental shift in the U.S. bond market's stability. For years, the Fed consistently became a substantial buyer, using quantitative easing with seemingly limitless resources. However, it is now transitioning to selling bonds, shifting from quantitative easing to quantitative tightening. Michael Pento anticipates that by March 2024, the bond market's liquidity may evaporate due to this shift. Furthermore, Michael points out that the substantial influx of stimulus money into bank deposits resulted in excess reserves, with a significant portion now parked in the reverse repo facility. However, this influx is slowly drying up, reducing reserves and posing challenges to the Federal Reserve's quantitative tightening, QT program. Once these reserves are depleted, every bond issued to support the massive $2 trillion budget deficit will need to be sold to the public without the assistance of the banking system, intensifying the chaos in the bond market.
I mean, the bond market is trading like a micro-cap penny stock. When you see yields jump 10 basis points every day, up and down on the 10-year, mostly up, and the flattening of the yield curve going from minus 100 basis points to minus 25 basis points a couple of days ago. Now it's minus 45 basis points. So that's how rapidly things are changing. You're seeing just the liquidity in the bond market drying up. And I think by March of 2024, so we're talking about 5 months from now, I think that the amount of liquidity in the bond market is going to completely evaporate. The Fed is no longer supporting the bond market. They used to be a big buyer in the bond market. Now they're a seller, $95 billion a month. So the buyers are gone. The buyers have become sellers, and there's this massive overhang of supply. And at the same time, if you want to believe the Atlanta Fed, GDP growth for Q3 is 5%, over 5% now. And if you believe the Labor Department, Bureau of Labor Statistics, inflation has gone from disinflation to reflation. We're going higher now, further and further away from the Fed's asinine 2% target. So you look at those 5 factors I just mentioned, the bond market is trading like a micro-cap penny stock. And come March of 2024, the reverse repo facility, so think about this. All of the stimulus from COVID ended up in bank deposits. These deposits create reserves, and the reserves excess reserves end up at the Fed because the Fed's paying them interest. There's $2.5 trillion of excess reserves in the reverse repo facility. That's down to $1.2 trillion. In the last 5 months, $1 trillion has gone out of the reverse repo facility, which is reserves out of the banking system, out of the economy, going into the economy. So it's offsetting the QT program completely. Come March, those reserves will be zero. No liquidity in the reverse repo facility. That means every bond that's going to be sold to support our $2 trillion deficit has to go to the public with no help from the banking system, no easy help from the banking system. In other words, it's not just like they're taking money from the Fed's one pocket and put it in the Fed in the other pocket. That's gone. So I think the bond market chaos is going to increase big time in March of 2024. And if you think that's going to be good for the stock market, boy, oh boy, it's going to be ugly. the treasury is being bought, Elijah. They want to get paid. They want to be compensated. I mean, if you look at 10, let's just look at the benchmark treasury. Usually trades about 200 basis points over inflation. Well, if that was the case today, then the treasury should be yielding 5.7%. It's not, instead of 4.7%. So treasury buyers need to be compensated for the inflation. Now, if inflation was 2%, then the 10-year note should be 4%, about that. You have to be compensated for going out in duration along the yield curve. So you are finding buyers, they just want to get compensated for that risk. The added risk of inflation, inflation was almost 20% in reality just about a year ago. So it's down now to 3.7%, but that's, still far above the Fed's target and far, far away from stable money. So it's just a matter of being compensated. You'll always find buyers for treasuries at a price, and the price is much lower than ever before, and the yield is much higher, ever before in recent times.
Investors are turning to the enduring security of precious metals like gold and silver as the stock market grows increasingly unstable and overpriced. With U.S. stocks at record valuations and Federal Reserve actions causing uncertainty, these metals act as safe havens for wealth preservation. What are your thoughts or concerns about the current state of the financial markets? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.